They didn't just sell silver yesterday, they engineered a liquidation. February 2026 is now stamped on the chart. The candle is there, the body is there. Momentum flipped violently in a single session. It looked like a breakdown. It felt like confirmation that the metals trade was wrong. Meanwhile, financial television calmly reassured viewers that the economy is resilient, consumer spending is strong, and technology remains the only rational place to allocate capital. But yesterday was not a silver story. It was not a gold story. It was a bond market story, and the number that matters, the number that should be forcing every serious investor to reassess risk, is 4.03%. That is the 10-year Treasury yield. If you don't understand why 4.03% is a macro signal with systemic implications, then you're watching price but missing structure. Let's examine what actually happened. Silver dropped sharply. Gold followed. The entire precious metals complex was hit. Retail sentiment deteriorated instantly. Social platforms filled with capitulation posts. Comment sections questioned the thesis. Emotionally, it was intense, but emotion is not analysis. When yields fall aggressively, bond prices rise. That inverse relationship is foundational. When bond prices surge in an environment where equity markets are supposedly stable and the Federal Reserve still describes policy as restrictive, that tells you something critical. Institutional capital is repositioning defensively. Large capital pools do not rotate into treasuries impulsively. They move when risk is increasing beneath the surface. This has happened before. In 2007, public messaging insisted that housing stress was contained. Meanwhile, treasury yields were falling months before the broader market recognized systemic risk. In late 2019, yield curve inversion and repo stress signaled funding instability before March 2020 unfolded. In 2022, aggressive tightening inverted the curve deeply. The bond market was signaling that something would break. Eventually, regional banks did. Now consider today's backdrop. U.S. federal debt exceeds $37 trillion. Debt to GDP is approximately 127%. Roughly $8 to $9 trillion of debt must be refinanced annually. At yields around 4%, incremental interest costs add hundreds of billions per year. Total annual interest expense is approaching $1 trillion. That is not sustainable if growth slows. So when the 10-year compresses to 4.03% in this context, it is not random fluctuation. The bond market is anticipating economic deterioration. Recessions force policy pivots. And historically, the Federal Reserve's response to recession is consistent. Rate cuts, balance sheet expansion, liquidity injection. But before the pivot comes phase one. Phase one is the liquidity phase. In liquidity phases, everything sells. Stocks sell, commodities sell, precious metals sell, institutions raise cash, margin calls are met, risk is reduced, liquid assets are sold because they can be sold quickly. Gold and silver are highly liquid. Therefore, they get hit. This does not invalidate the macro thesis. It confirms funding stress. March 2020 is the clearest example. Silver fell from $18 to $11 in weeks. The thesis was declared dead. Then, the Federal Reserve launched unlimited QE. Within 5 months, silver nearly tripled to $29. In 2008, silver collapsed toward $8 at peak panic. By 2011, it traded near $49.50. Liquidity phase first, monetary expansion phase second. The 4.03% yield suggests we may be transitioning between those phases. If recession pressure builds, rate cuts follow. When rate cuts arrive, real yields compress. When real yields approach zero or turn negative, hard assets historically reprice aggressively. The 1970s, 2011, 2020, each featured negative or collapsing real rates. Each produced powerful moves in gold and silver. Now add structural fundamentals. Global silver mine supply sits near 850 million ounces annually. Industrial demand, especially from solar, has surged. Solar consumption alone has approached or exceeded 170 to 200 million ounces per year. Total demand has exceeded supply and documented structural deficits. This is not projection. It is confirmed by industry data. So the backdrop includes a bond market signaling slowdown, a fiscal position incompatible with sustained high rates, a Federal Reserve historically inclined to cut into weakness, structural silver supply deficits, ongoing industrial demand growth. Yesterday's drop, in that context, resembles liquidity stress, not structural collapse. The question is not whether volatility continues. It will. The question is whether the bond market is early or correct. If it is correct, phase two follows, and phase two changes everything. Let's quantify the pressure. Federal debt, $37 trillion, GDP, $29 trillion, debt to GDP, 127%. Annual refinancing needs, $8 to $9 trillion. At average rates near 4%, Rollover alone adds roughly $360 billion annually in incremental interest. Combined with existing obligations, total interest expense approaches $1 trillion per year. If recession reduces tax revenue, deficits widen. The Treasury must issue more debt. If private markets demand higher yields to absorb that supply, financial conditions tighten further. At some point, policymakers face a choice: allow yields to rise and risk systemic instability, or intervene. Historically, intervention wins. That means balance sheet expansion returns. Now consider monetary aggregates. M2 money supply sits near $21 trillion. Estimates of above-ground investable silver hover around 3 billion ounces. Even acknowledging estimation variance, the ratio of broad money to investable silver is extreme. If only a small fraction of monetary expansion reprices into silver, triple-digit price levels are mathematically plausible, without requiring systemic collapse. This does not require $7,000 silver. It requires modest repricing relative to monetary expansion and supply constraint. Now layer in geopolitical context. Since 2022, central banks have accelerated gold accumulation. Reserve diversification away from the dollar has been gradual but persistent. The weaponization of reserve assets altered central bank behavior. Gold purchases have surged to multi-decade highs. Silver is not a primary reserve asset, but it occupies a dual role: monetary hedge and critical industrial metal. Solar expansion in China and India continues at scale. Electrification initiatives remain metal intensive. Structural demand remains firm even during economic slowdowns due to policy commitments. So silver now sits at the intersection of monetary debasement risk, industrial structural deficit, fiscal instability, potential policy pivot. Against that backdrop, futures market dynamics matter. The precious metals complex has a history of documented spoofing and short-term distortions. Large concentrated short positions and roll mechanics influence pricing. As long as funding markets remain stable, leverage persists. But if liquidity tightens, if repo funding stress emerges, the cost of maintaining large short exposure rises. Short covering can accelerate quickly once positioning flips. Historical precedents show that repricing events in silver are rarely gradual. Each followed extended periods of suppression or stagnation. Each resolved violently. Now return to the yield. 4.03% is not just a number. It suggests growth expectations are deteriorating. If that continues and the Federal Reserve cuts 100 and 200 basis points or more, real yields compress rapidly. Historically, that environment has been highly constructive for precious metals. A $100 silver target under such a scenario is not extreme. It is a conservative milestone within a broader repricing framework. Assuming gold yields continue trending lower, the Fed cuts materially, structural deficits persist, industrial demand remains intact. None of that, but suppression mechanisms can extend timelines without eliminating underlying arithmetic. Structural imbalances build pressure. When the release comes, it compresses into a shorter time frame. Coiled spring dynamics are rarely linear. Yesterday's liquidation was phase 1 behavior. If the bond market signal proves accurate, phase 2 follows. Phase 2 is rate cuts. Phase 2 is liquidity expansion. Phase 2 is negative real rates. Phase 2 is metal repricing. The chart shows volatility. The bond market shows stress. Fiscal math shows constraint. Policy history shows pattern. Watch the yield. Because if 4.03% continues downward, the next move in silver will not look like yesterday's candle. It will look like repricing. And repricing phases, historically, do not move in increments. They move in jumps. To understand why the recent move in yields matters so much for silver, you have to look beneath the surface, into the plumbing of the financial system. Because price action in the precious metals market is not just about supply and demand in a traditional sense. It is about leverage. It is about funding. It is about the repo market. The repo market, short for repurchase agreements, is the collateralized overnight funding mechanism that allows large institutions to borrow against assets and maintain leveraged positions. It is one of the core liquidity engines of the global financial system. When repo funding is abundant and cheap, leverage expands easily. Short positions in futures markets can be maintained with relatively low carrying cost. Positions are rolled from one contract month to the next. The system functions smoothly. But when liquidity tightens, the cost of leverage rises. When funding stress appears, balance sheets contract. And when that happens, leveraged short positions become vulnerable. This is where silver becomes uniquely interesting. The COMEX silver market operates primarily in paper contracts. The notional volume of futures contracts far exceeds the amount of physical silver available for delivery at any given time. That structure allows for significant price influence through derivatives positioning. Historically, large concentrated short positions have existed in the silver futures market. This is not speculation. It has been documented. Major institutions have faced enforcement actions for spoofing and manipulative practices in precious metals markets. The mechanics are real. But here's the critical point. As long as funding markets are stable, those short structures can persist. When funding becomes unstable, they cannot. The 10-year yield compressing to 4.03% suggests a shift in capital positioning toward safety. If that trend accelerates, broader liquidity stress can emerge, particularly if recession risk increases and credit spreads widen. In a liquidity squeeze, phase one hits everything, including silver. But if that squeeze evolves into systemic stress requiring policy response, then the second-order effect becomes powerful. Rate cuts reduce funding costs, real yields compress, and short positioning becomes more dangerous as price begins to rise. At some point, what was a manageable carry trade becomes a risk event. When short covering begins in size, silver does not grind higher slowly. It gaps. History demonstrates this repeatedly. In 1980, silver's ascent into $49.50 was rapid once positioning stress intensified. In 2011, the move from the low 30s to nearly $50 occurred in a compressed time frame. In 2020, silver's move from $11 to $29 unfolded in months, not years. Silver repricing events are nonlinear. They occur when structure breaks. And structural breaks typically coincide with macro regime shifts. Now consider the broader global monetary framework. The US dollar still represents roughly 58% of global foreign exchange reserves, down from above 70% 2 decades ago. That decline has been gradual but persistent. Since 2022, central banks, particularly in emerging markets, have increased gold purchases at one of the fastest paces in modern history. The freezing of sovereign reserves altered how non-Western governments view reserve risk. Gold accumulation accelerated. At the same time, alternative trade settlement mechanisms have expanded. Bilateral agreements in local currencies, increased use of yuan in commodity trade, incremental diversification away from exclusive dollar reliance. This does not mean dollar collapse. It means gradual structural adjustment. Silver occupies a unique position in this environment. It is not the primary reserve asset like gold, but it is a monetary hedge, a critical industrial input, a strategic component in renewable infrastructure. China and India continue expanding solar capacity aggressively. Solar installations require silver in photovoltaic cells. Even with efficiency improvements reducing silver per panel, total volume expansion has kept aggregate demand elevated. Annual mine supply has not surged proportionally. This creates a persistent deficit dynamic. Now combine structural industrial deficit, monetary expansion risk, bond market signaling slowdown, potential policy pivot, concentrated derivatives structure. You begin to see the asymmetry. The downside in silver is constrained by real production cost and structural demand. The upside, under a negative real rate regime, is historically explosive. Let's build a realistic pathway, not a fantasy scenario. In 2020, silver moved approximately 160% off its liquidity low once the Federal Reserve initiated aggressive easing and QE. That move occurred in a debt environment materially smaller than today's. Federal debt in 2020 was roughly $27 trillion. Today it exceeds $37 trillion. The system is more leveraged. The margin for sustained high rates is narrower. If the Federal Reserve cuts aggressively into recession, for example, 150 to 200 basis points, real yields could quickly approach zero or negative territory again. Every modern instance of negative real rates has coincided with strong precious metals performance. 1970s, sustained negative real rates. Decade-long bull market. Post-2008 QE era, gold and silver surge into 2011. 2020, emergency easing, rapid metals repricing. A move to $100 silver does not require hyperinflation. It requires sustained yields below 4.5%, trending lower, Fed rate cuts into economic weakness, persistent structural supply deficit, continued industrial demand growth. If silver were to replicate even a scaled version of prior easing cycle performance, adjusted for today's tighter supply backdrop, triple digits become mathematically defensible within the macro cycle. Importantly, $100 is not a claim of immediate repricing. It is a milestone within a broader cycle. Markets move in phases. Phase 1, liquidity squeeze, broad asset selling, volatility spike. Phase 2, policy pivot, rate cuts, balance sheet expansion. Phase 3, real yield compression, currency repricing, hard asset surge. We appear to be late in Phase 1. The bond market, through the 4.03% yield, is signaling that Phase 2 is approaching. None of this eliminates volatility. Silver will remain volatile. It always is. But volatility is not thesis failure. It is characteristic behavior of an asset sitting at the intersection of monetary policy and industrial demand. The mainstream narrative focuses on quarterly earnings and sector rotation. The bond market focuses on economic stress. The fiscal math focuses on sustainability. When those three diverge, the bond market usually resolves the tension. Right now, the bond market is speaking clearly. The yield is compressing. If it continues, policy response follows. And if policy response follows, silver's recent candle may not mark a top. It may mark the final liquidity flush before repricing accelerates. Watch the 10-year. Watch real yields. Because when those move decisively, silver will not wait for consensus.